How can you plan ahead for what can be a very painful tax process, required minimum distributions? I've got four strategies that you can limit your RMD out there in the future and the taxes that accompany it. I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. As you're saving up for retirement, you're going to want to do so in tax shelters using a tax shelter strategy. Should it be pre-tax? Should it be Roth? Okay. When you're contributing pre-tax, just know that at some point, you've contributed into this account. You've been able to deduct your contribution on your taxes. All the activity in that account all along the way is not taxed. It's sheltered from tax. So at some point, the IRS says, take the money out. You've got to take this money out and report it on your tax return because you've avoided taxes on this money for long enough. And you might think, well, the strategy is get the tax deduction on the contribution on the way in because you're in a high tax bracket, and then pull the money out and pay tax on it in retirement because you're in a low tax bracket. But get it. I love it. The strategy works. It doesn't work in every situation, because if you saved up so much that all of a sudden the amount you need to draw out in retirement isn't that much, well, then you reach required minimum distribution age. Used to be 70.5, then it became 72, now it's 73, it's about to become 75, but other than that, it's super simple. Then you're going to be required at a certain age to withdraw more than what you really need. And when you have to withdraw more than what you really need, is that such a bad thing? Well, the taxes that accompany it, yeah, they could be bad. It could put you in a position where you avoided a certain tax bracket on the way in, and you're having to pay that same or higher tax bracket on the way out. Plus, you might have to pay more tax on your Social Security. Plus, you might have to pay income-related monthly adjustment amount, IRMA, because your RMD was so high, you're forced to pay a higher amount for your Medicare Part B and Part D. People don't like their RMD, their required minimum distribution. It's not. If you're in a situation where when you retire to supplement your Social Security, you need to draw a certain amount out, and that's plenty to cover your required minimum distribution, then you're in a great spot. I would say 10 years ago, that was a pretty common scenario. Today, it's less common. I see more and more situations where people are forced to take more in RMD than what they actually need, and the taxes can be egregious. So, what are some strategies that you can use to limit the required minimum distribution that you're going to be subject to out there in the future and limit the taxes that accompany it? Number one, and this one's obvious, and that is to make Roth IRA contributions or Roth 401k contributions during your working career. There is no required minimum distribution on Roth IRAs, and even though right now under current rule, there is RMD on Roth 401ks, they actually fixed that for next year. I don't know why they didn't fix it immediately, but they fixed it for next year. And most people don't leave Roth 401ks in 401ks. They roll them over to Roth IRAs anyway. And so there's no required minimum distribution on Roth accounts. Therefore, if you're willing to not get the deduction up front and say, well, I'll pay the taxes now, the money that I contribute to my Roth 401k, Roth IRA, and then out there, all the activity will be sheltered. Any growth on that, I'll be able to pull out tax-free, and there's no required minimum distribution. That makes a ton of sense and obviously limits your RMD. And if you say, well, okay, that's not that big of a difference, and I really prefer the deduction this year. Well, then consider this strategy. Maximize your pre-tax 401k contribution, but then also max your Roth IRA. That allows you to contribute more for retirement with a chunk of it, probably 75% or 2/3 of it going pre-tax, but another 1/3 or another chunk going Roth, and therefore you've got tax diversification so that out there in the future, as you're drawing dollars out or as tax rules change and you need to make some decisions, you've got dollars that are both pre-tax and Roth. That will help you limit and manage your RMD. The second strategy to limit your RMD out there in the future, and this is the big one, and that is doing Roth conversions during low income years or early in retirement. Low income years or early in retirement. Right now we're seeing some softening in the overall economy. There's a lot of layoffs. There's some that are hitting the headlines, others that are not. I'm talking to clients and they're saying, yeah, I mean, our company just let go 100 employees. And so that is starting to happen again. And if that happens to you, or you are your hours are reduced or something like that, and all of a sudden your income's going to be less this year than what you'd expect and hope out there in the future when your employment goes back up, that might be the right time to do some Roth conversions, because you've got a long time in your career left. And because your income's down, you're in a lower tax bracket, okay? So doing some Roth conversions, that's a way to make some lemonade out of some lemons if your hours or job is being reduced. The other time to do it, and I just absolutely love this strategy, is early in retirement. Love the strategy of someone retiring early, have some cash that they've set aside that they're going to live on and either delay Social Security or supplement their Social Security, and have very little income, and do 2 or 3 years of Roth conversions to take, $250,000, $300,000 from their IRA, transition it into the Roth while they're still young, early in their retirement, and be in lower tax brackets. So that's the second way to limit your required minimum distribution, is to, during low income years or early in retirement, do Roth conversions. Third way to limit and manage your required minimum distributions, especially those of you that are looking and saying, well, I don't like the Roth because I want the deduction today, and that is consider shifting your HSA from a spending HSA to an investing HSA. And you might say, well, that's not in Webster's dictionary. What's the difference between those? Yeah, those are our terms, okay? A spending HSA is where you're putting money in the HSA, and then every time you go to the pharmacy, every time you've got an out-of-pocket medical expense, you're swiping that HSA debit card and spending the money. Okay, so that's a spending HSA. You put the contribution in, you get the deduction, and you're spending the money right away. A lot of people, you need to do that from a cash flow standpoint. But if you don't, if you can make some sacrifices, then an investing HSA is you're still contributing the maximum amount, or as much as you can, to the HSA, and you're getting that deduction. But instead of using your HSA for your, the prescriptions, your out-of-pocket expenses, you pay for that out-of-pocket yourself. And you leave your HSA dollars there, and you actually invest them for retirement. And the reason why this helps you with RMD, your required minimum distribution, is there's no requirement out there in the future, even though that's pre-tax money into the HSA, just like the IRA or pre-tax 401k, there's no requirement at some point where the IRS says, well, there's a required minimum distribution on this HSA. There isn't. Will there be in the future? Gosh, I could expect so, but there isn't right now. And therefore, you can use this that HSA, you can invest it, and all the money that you're spending out of pocket, you can save those receipts and in the future reimburse yourself from your HSA. So third strategy, and this is sort of best of both worlds. You get the tax deduction today, no RMD in the future. Third way to manage your RMD is treat your HSA as an investment HSA, not a spending HSA. And then the fourth strategy to limit your required minimum distribution is one that's more reactive than it is proactive. In financial planning, the principle here is get proactive, be proactive. You can't predict the future, but you can plan for the future. And it might not turn out, in fact, I know it won't turn out exactly the way you planned, but you'll be more prepared for whatever comes your way because you've been planning ahead. If you're listening to this saying, I haven't been saving a lot into the Roth, or I have, but I'm still going to have a large RMD, it's more than what I really need, now what should I do? Well, then the fourth strategy to limit your RMD is really to limit the pain of it, and that is by doing qualified charitable distributions. Qualified charitable distributions, QCDs, and that is where you're using some of your RMD to make your charitable donations to 501c3 charities that you want to support, causes you want to support. You can do this. You're allowed, even at age 70 and a half. This one didn't change to 72, 73, 75. It's still at 70 and a half, where you can donate money directly from your IRA, directly to the church, directly to your favorite 501c3, and that money coming out will help satisfy, it will go towards your required minimum distribution, but it's not going to be taxable. Because the money went, instead of going to you to the church, it goes directly to the church from your IRA. That counts towards your required minimum distribution, the amount that you're forced to withdraw, but the money that goes directly to the church, directly to the charity, that's qualifying for this QCD, doesn't land on your tax return. So it's a way of managing your required minimum distribution without it being taxable. Guys, there's way more than 4 strategies to help you manage your required minimum distribution. And so work with your certified financial planner. They've got to be doing comprehensive financial planning. If not, they're not gonna help you with this. They're just gonna tell you what the amount is for your RMD and say, well, here's how much tax you should withhold. They might not even say that. You want to work with someone that is proactive, looking ahead at your financial situation and your tax picture, saying, well, based on that projected future, what adjustments, what planning, what decisions should you make today? Work with your CFP on that. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.